In the last video, we talked about stock valuation based on the assumption of constant dividend growth. For that equation to work, we mentioned two very important assumptions. That first of all, we need to have constant growth in the dividend, and constant meaning same growth rate that goes from the very beginning to infinity. And we also need the growth rates to be reasonable and also lower than the required rate of return for stockholders. So this equation usually works pretty well for mature companies that do have stable growth. However, not all companies in the market are mature companies that have stable growth. For example, high growth companies that experience very high growth rate at least for the next couple of years. So for those high growth companies, we cannot really use or apply the constant growth formula directly because we know those companies cannot really sustain the high growth rate forever. If we look into those companies, we realize those companies may have two stages of growth. As you see from this picture here, stage one is when they have the high growth rates. We will call it G1. So that's for the first couple of years. Maybe they have a new technology, new products, so sales skyrocketed and a very high growth rate for the first couple of years. But then, as the competition catches on, maybe they cannot maintain the same high growth rate for too long. So after certain years, the company will slow down and have a more stable growth. When that happens, for the stable growth rate, we'll call it G2. G2 is more like the constant growth that we look at in the last video. So to understand this, think about companies like Apple. During 2007-2008, that's when Apple introduced the iPhone, which is revolutionary. So when the iPhone and also iPad came out, you can imagine sales grew a lot for those years. But then a lot of companies are making and selling smartphones, and they got a lot of competition, and also the market saturated. So the growth rates nowadays for Apple is not as impressive as what you would see 10 years ago. That's why we can look at Apple's growth as maybe multiple stages. Well, stage one is when the new iPhone and iPad came out, very high growth rate. And then stage two is when they start to slow down and have a more stable growth rates. So under that idea, if you now look at the timeline, if we started from year 0, so that's when the company just paid a dividend of D0. And so if we say the nth year, maybe it's and will be 5. So the 5th year is when things start to slow down. So then 1 year later, so D6 will be D5, now multiplied by 1 plus G2. Then if you think about first couple of years, or say first n years, all high growth rate of G1, so you can imagine dn is actually D0 multiplied by 1 plus G1 at the power of n. And the n plus 1 here will be dn multiplied by 1 plus G2. So if you understand those, now let's come back to the first equation here on this slide. We try to calculate the so-called terminal value. So the terminal value essentially is the present value of the second growth rate. What does this mean? If you look at this table or a timeline here, remember stage 2 is when things slow down and the company now is having a stable or constant growth of G2. So we want to know what would be the value of the company stock at the end of year n. We actually call this the terminal value. Because of the assumption of a constant or stable growth rate of G2 after year n, we actually can apply the constant dividend growth model to estimate the value of the stock at the end of year n based on the dividends after the nth year. So if all these talk about n plus 1 confuse you, just say, for example, if n is 5, so high growth for 5 years, and then starting from year 5, low growth or stable constant growth after year 5. So we want to know what is the value of the company's stock at the end of year 5 based on all the future dividend after year 5. So in year 5, the price will be depending on D6, 5 plus 1 here, the next dividends after this year. The denominator will be I minus G. Well, G here, we should use G2 because that's the constant stable growth rate at stage 2. So this is like, forget about the first stage. If we only have the second stage, what would be the price of the stock at this point? And we do have constant growth thereafter. We can apply the constant dividend growth model. So what you see here in this equation essentially is the constant dividend growth model. The only difference between what you have here and what you had from the last lecture is instead of having P0, now we have Pn. Now here, because of the assumption that high growth in the first, say, 5 years and low growth after year 5, D5 is actually D0 growing at this high growth rate of G for 5 years. And then D6 will be D5 multiplied by 1 plus G2, growing by the slow or stable growth rate of G2 for just 1 year. So again, if you think about this equation, this is exactly the constant dividend growth model. And the only complicated part here is we need to find the Dn plus 1, which is the dividend 1 year after this terminal year. And the so-called terminal year here is when things start to slow down and start to have a constant dividend growth. Once you estimate the terminal value, now forget about stage 2 and think about the first n years. So imagine you are trying to buy the stock today, which means you have to pay for the price today, and then you get to hold the stock for n years. And then you're going to sell the stock at the end of year n. How much can you sell it for at the end of year n? Well, you estimated the price, right? So how much you want to pay for it today should be based on how much you can receive as all these years of dividend and this final sale price. Now, if you remember, we did talk about valuation of the stock based on dividends and the final sale price, right? So in this case, your Pn is the terminal value, and how much do you want to pay for the stock? Again, depends on all the dividends you can receive in stage 1 plus the terminal value, which is the price you can sell the stock for at the end of stage 1. So now if you look at this equation and what you have here, you realize they're the same thing. So D1 is D0 multiplied by 1 plus G1, and D2 is D0 now growing for the same growth rate for 2 years. And Dn is D0 growing by the same high growth rate for n years. And now for the terminal value, that's the price of the stock at the end of the whole stage 1. So you are supposed to calculate all these, all the present values and sum them up. That's the price of the stock as of today, year 0. I understand all these long equations can be a little bit confusing, so the best thing to do to get comfortable with them is to look at an example. Here we are looking at a company that currently pay a dividend of $5, so D0 is 5, and then we expect the company to grow the dividends at 10% for 3 years. So first 3 years, high growth rate of 10%. So if you look at the timeline, we can imagine first 3 years, high growth, and after that, 4% stable growth. required rate of return, little I, is 9%. So how do we apply what we just talked about as the multiple steps to finally get the price, or say the value of this stock? Well, the first thing we want to do is we calculate the dividends, D1, D2, D3, and D4. So D1 is the $5 multiplied by 1 plus G. You notice G here is the high growth rate in the first stage, and D2 is D1 growing by another 10%. And you can also calculate D2 as D0 multiplied by 1 plus 10% at the power of 2. You will get the same result, $6.05. D3 is D2 growing by another 10%, or you can write it as D0 multiplied by 1 plus G at the power of 3. Either way, you get 6.655. And now D4, pay attention here because D4 is not D3 multiplying by 1 plus 10%. Instead, it's only 4% now because after year 3, 4% low growth rate till forever. So D4 is actually D3 multiplied by 1 plus G2, the 4% low growth rate. And we can stop here. So in case you ask, how many dividends should we calculate here? Generally, we calculate all the dividends in stage 1, or say before the growth rate gets stable. In this case, it takes 3 years for the growth rate to slow down to 4%, so we'll get all the first 3 years, D1, D2, D3. And then 1 year after the growth rate gets stable, so just one more, we get D4, and we do not have to go on and calculate D5 or D6. Now, let's calculate the terminal value. So we calculate P3 as the terminal value. So if you look at this one and the one here, you realize we just applied this formula. Well, n is 3 for this question. So P3 is BD4 divided by I minus G2. G2 should be the low 4% growth rate. So D4 is calculated from your last slide to be $6.92. It is essentially the $5 multiplied by 1 plus the 10% at the power of 3, and then multiplied by another 1 plus 4%. So you can just do it one step, or you can actually break it into multiple little steps here to calculate D1, D2, D3, D4 one by one. Either way, you calculate the terminal value in step 2, and it is $138.42. Last step, you can either look at this whole long formula, or you can think about the rationale behind it. If you buy the stock at time 0 and you hold it for 3 years, what do you receive from the stock? You receive one dividend at the end of year 1, another dividend at the end of year 2, and another dividend at the end of year 3. So 3 dividends, and now it's time for you to sell the stock. And if you do sell the stock, you will receive $138.42. Now also, if you do sell the stock, you're not going to receive more dividend from the stock. So you don't see I have D4, D5, D6 anymore because they are actually already included in the $138.42. $138.42 is actually the present value of all the D4, D5, D6 till D forever as of the end of year 3. So now this question is about what is the total present value of all these cash flows in the next 3 years. And at this point, it should not be very hard for you because you know from chapter 5 about how to calculate the total present value of these multiple cash flows. The final result for P0 should be 122.17. You can also think about using your financial calculator to calculate the total present value instead of having to manually calculate all these present values by yourself. So you may want to go back to your notes in chapter 5 and try to figure out how to use your financial calculator to calculate the NPV of these different cash flows under a discount rate of 9%. So far we talked about using the variable growth technique to handle stock valuation for the stocks or companies that do not really have a very stable growth. The idea is we try to find a terminal year and try to estimate a terminal value based on the constant dividend growth rate. And then we try to look at this investment horizon and figure out the price we want to pay for the stock today based on the dividends that we expect to receive from the stock and the final sale price, which is also the terminal value of the stock when we try to sell the stock at the end of the high growth period. The last approach we want to talk about in this chapter for stock valuation is the PE model. This is to estimate the so-called relative value of a stock. So we try to see the value of one stock relative to the others. And in practice, people use the PE ratio a lot in this relative value approach. And if you remember from chapter 3, PE ratio is P over E, which is the current price of the stock, over the EPS, earnings per share. So the idea is, if we have some good idea about what a PE ratio for a stock should be, and also we try to estimate the company's EPS in the future, which is based on the company's current EPS and your assumption about how much the EPS can grow for the next couple of years in the future. So this part here essentially is the future EPS. So for example, if the EPS is expected to grow at 5% for 5 years, so then after 5 years, the EPS will be current EPS multiplied by 1 plus 5% at the power of 5. And so if we know the EPS 5 years later, then use the future EPS multiplied by the PE ratio. So think about the E and the E part can cancel out. We can get some idea about the price of the stock 5 years down the future. So that is the idea of estimating future stock price based on a PE ratio and your forecast of the future EPS. So in this example, if the PE ratio you think 12.98 is a reasonable PE ratio for Caterpillar, and currently the EPS is 5.05, growth rate is going to be 12.8 for the next 5 years. So 5.05 today multiplied by 1 plus G, which gives you 1.128 for 5 years. So this part will be the EPS 5 years later. And if 5 years later the PE is still 12.98, you use the PE multiplied by the EPS, then you get the estimate of the price 5 years later as 119.70. So here for the PE ratio model, we'll just use this simple example to explain the idea of the so-called relative value, just to let you understand that price can be estimated as a product of the PE ratio and the earning forecast. So to conclude this whole chapter, in this chapter we have learned to understand a lot of issues about stocks, stock investment, and stock market. So for common stockholders, their rights, the returns and risks in investing in common stocks. And in terms of the stock market, why do we need a well-functioning stock exchange? And how does NYSE and NASDAQ operate differently? When it comes to track the stock market, what are the stock indexes? And for example, you need to understand what is S&P 500 about, and how is S&P a little bit different from the Dow in terms of the coverage of the markets. In terms of stock trading, we need to understand the difference between a market order and limit order, and we also should be pretty good at reading the stock quotes and understand all the information we get from the quotes. In terms of the calculation in this chapter, we try to compute the stock price based on the so-called constant dividend growth model. And we also extend the constant growth model to estimate the stock value for a company with high growth or say variable growth. And all these valuation methods or approaches are based on the idea that the value of the stock should reflect the total present value of the future cash flows that investors expect to receive from the stock. We also talk a little bit about the PE model and how we use the PE estimate and future EPS to estimate the price of a stock in the future. So that's chapter 8.